Hi, my name is Stanley and I'm here to tell you everything you need to know about stock market investing in under 12 minutes. So the first thing you need to understand is what exactly is a stock? Well, a stock is a piece of a business, and the best comparison for this is thinking of a business as a pie, and a pie slice being a stock or a piece of that business. So using an imaginary example, I own a business that sells green beans, call it Stanley's Green Beans. Let's say for the sake of example, there are 100 shares of this business, and the total business is worth $1,000. So each share therefore is worth $10. If I own 20 shares of the business, then I own 20% of this bean selling operation, and the total amount of my shares are worth $200. Now, let's use an example in real life. I'm sure you heard of Apple, right? You know, the company that makes iPhones. At the time I'm making this video, the company is worth a whopping $2.832 trillion with about 15.79 billion shares. So if we divide 2.8 trillion by 15.79 billion, we get the price per share, which is about $179. So if you buy one share of Apple, you own one share out of the total 15.79 billion pieces of Apple. Companies which have these pieces or stocks traded publicly are known as publicly traded companies. Companies sell these shares to the public in something called an initial public offering or IPO in order to raise money for their business. And the place where all these individual stocks trade is called the stock market. Now, there are many different stock markets out there. The most well known to you is probably the New York Stock Exchange. So now that we've established that when you buy a stock, you're buying a piece of a business, let's talk about how to make money in the stock market. So the key to making money in the stock market is, wait for it, you buy stocks that go up. Yep, that's basically it. Stocks go up and down based on supply and demand. So when lots of investors are buying the stock, the price goes up. And if a lot more investors sell the stock than buy it, well, that stock's going down. Whether or not investors lean towards buying or selling a stock depends on investor expectations. And there are probably a million things that affect an investor's expectations on short-term price movements of stocks. Some of these include economic conditions, company earnings, which side of the bed Jerome Powell woke up this morning, and random news events that may or may not be related to the company. Strategies that try to profit off these short-term price movements are known as short-term investing strategies, also known as trading. And for the sake of this video, we're going to skip this because most investors should avoid this style of investing. The reason is because short-term price movements in stocks are notoriously difficult to predict, and if you don't know what you're doing, it's kind of like playing the slot machine except you have worse odds. And if you don't believe me, just check out the Wall Street Bets subreddit. Now let's go to long-term investing. This is the holy grail of investing where most successful investors make the majority of their money. And it's based on the idea that long-term stock price movements are based on how successful the company is going to be in the long term relative to current investor expectations. So if the company in the long run outperforms investor expectations, then you're going to make a lot of money. If it does relatively the same, then you make average returns, and if it underperforms, then you're very likely to lose money. The key idea behind long-term investing is that while prices for stocks are very difficult, if not impossible to accurately predict in the short term, with the right training, you can fairly reliably predict how well a company is going to do 5 to 10 years from now relative to current investor sentiments. And the better investor you are, the more reliably you can predict these long-term stock prices, and the more stocks you can predict these long-term prices for. And the main idea behind long-term investing is a concept called intrinsic value. To give you an idea of intrinsic value, I like to compare buying a stock with buying a consumer good, let's just say a car. Now let's just say you were out shopping for a new vehicle because unfortunately your old one broke down on you, and you walk into the dealership and your favorite sleazy salesman comes in and says, "Hey, howdy, don't I have a great deal for you today?" "Oh really?" you say in a skeptical voice. "Yeah, we got this wonderful deal for this used 2013 Honda Civic. It has some AC issues, but I'll give you a great deal. How's $1,200? And you're about to walk out when you remember that you've seen these cars selling for about $10,000 to $15,000 online, and most air conditioner issues can be repaired for, say, under $5,000. So if in the worst case scenario, you can repair the AC issues for $5,000, sell the car for $10,000, you can make a handsome profit of $3,800, which is $10,000 minus the cost to buy the car, $1,200, minus the cost to fix the AC, $5,000, and you're left with $3,800. And if worse comes to worse and you get no biters, you estimate you can at least sell the parts for $1,500. Now, would you take that deal? Well, of course you would, because here you estimated that the intrinsic value of the car is around $5,000. That's $10,000 minus the cost to fix the AC, which is $5,000. The car salesman is offering to sell you the car for $1,200, so you're getting the car for a 76% discount. And that 76% in investing terms is called your margin of safety. And you determine that there's no risk of losing money because in the off chance you can't sell the car, you can just sell the car for parts and make a small profit of $300. So you're probably asking, how does this apply to investing? Well, each day in the stock market, Mr. Market, or we can say Mrs. Market, offers you all kinds of deals on stocks. $180 for a share of Apple, or $12.39 for a share of Ford, or $289.91 for a share of McDonald's, and so on. And as an investor, you can calculate the intrinsic value of these shares of stock and compare it to how much the stock is actually selling for. So if the stock is trading much higher than its intrinsic value, it means the market's being overly optimistic. And if it's trading well below, it means the market's being overly pessimistic. And your job as an investor is to determine whether or not the companies are selling at discounts, selling at fair values, or selling really expensive relative to how much you think they're actually worth. And as an investor, you'll find the majority of deals that Mr. Market offers aren't very good. A few might be okay, and once in a while you can find an absolute steal, just like in the example with the desperate car salesman. Your goal as a long-term investor is to find enough of these bargains, hold on to them long enough for their value to rise, and then cash out. The better you are at finding these and holding on to these stocks, the more money you make, and the better you'll do as an investor. And there are many different ways to calculate a stock's intrinsic value. They're typically categorized into two areas. So on one hand, you have your fundamental quantitative analysis. This is looking at the business's price relative to a bunch of metrics that are easily measured, such as earnings, expenses, assets versus liabilities, debt, cash flow, etc. On the other hand, you have your fundamental qualitative analysis. This is valuing the business based on a bunch of non-number-based factors, such as strength of the brand, quality of the management team, competitive advantage, etc. And there are thousands of books written on how to value businesses. If you're interested in more of these types of videos which go over how to calculate intrinsic value, please comment down below and just let me know you'd be interested in watching something like that. Okay, so we're approaching the 8-9 minute mark, and there's one more concept that's really important for investing. Have you ever read a story or was told a story somewhere about this girl who came from a family without a lot of money, who used rice to bankrupt a king? Well, it goes something like this. So the king, on one of his grand tours of the city, strolls by with his entourage and spills some rice. And a girl picks up that rice, and to reward that girl, the king says that she can have anything she desires. She asks for 1 grain of rice, and over the course of 30 days, each day the king needs to double the amount of rice she gets. And the king, being not very great at arithmetic, accepts. And it all works out for him until the 30th day when he has to pay out 1,073,741,824 grains of rice. Investing is the same idea. Most people think that to be successful in investing, you have to take some big risks and get a crazy return like 30 or 50%. But actually, you can be successful in investing by only averaging about an 8% return per year, which is the average for the largest 500 companies on the New York Stock Exchange. And this is because in your first year, let's just say you make 8% and you're left with 108% of your original investment. Say in your second year, you make another 8%. Now you would have 8% on top of your 108%, which will bring you to 117% of your original investment in your second year. And let's just say in your third year, you bring in another 8% return. That would be 8% on top of the 117% you have, which would bring you to 126% of your original investment at the end of your third year. So it works a little bit like a snowball. And over the course of 40 years, by leaving your initial investment, you can make about 21.72 times your original investment. So if you put in $20,000 at the age of 25 and you check back at age 65, you would have $434,490.43. So essentially, just letting your $20,000 sit there for 40 years making 8%, you earn $414,490.43 over the course of 40 years. And that is known as the power of compound interest. However, there's limitations to compound interest as well. Let's just say at the age of 25, you gambled away half of your $20,000 in a bad investment. How many years would it take you to recover that money through investing? Well, if we do some quick math here, we can find out that it would take you about 9 years to recover how much you had originally. And the moral of this is that in investing, the most important thing in the long term is consistency. As an investor, you need to first focus on protecting yourself from risky and bad decisions that cause you to lose money, and then focus on making money. Most investors should aim in the beginning to put the majority of their money in an index fund, which tracks the performance of the largest 500 companies on the New York Stock Exchange. Some popular examples of these index funds are SPY and VOO. If you are going to invest, always benchmark what you're doing with the performance of an index fund. Ask yourself the question, is the risk I'm taking by investing in this company going to be worth giving up an almost guaranteed 8% return over the long run? Well, I hope this video was helpful in teaching you about what the stock market is and how to make money in it. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Let me know in the comments what kind of video you'd like to see next. Till then, it'll be Stanley signing off. Thanks.